1031 exchange. What it is, what it isn't, and costly mistakes. A 1031 exchange can defer tens of thousands of dollars in capital gains taxes. It can also lock you into an even worse deal under a 45-day clock. Most investors don't realize that until it's too late. So today, I'm going to explain what a 1031 actually is, what it is not, how it works, and the mistakes that cost people real money. Let's start simple. A 1031 exchange gets its name from Section 1031 of the Internal Revenue Code. At the most basic level, it allows a qualifying real estate investor to exchange real property held for investment or productive use in a trade or business for other qualifying real property and defer recognition of gain that otherwise might be taxable at the time of the sale. Notice the word I used, defer, not eliminate. That's an important distinction. People sometimes talk about a 1031 exchange like it's some magical way to sell real estate and never pay taxes. That's not what I'm telling you. Generally speaking, you're carrying your tax basis forward into the replacement property. You're positioning recognition of the gain under the rules. And what ultimately happens from there depends on what you do with the property and your individual tax circumstances. And we're going to come back to that towards the end of this video because there's a really interesting long-term strategy that some investors use involving multiple 1031 exchanges and estate planning. But first, you need to understand how the exchange actually works. Quick disclaimer, before we go any further, I'm a real estate broker and a real estate analyst. I'm not your CPA or your tax attorney, and this video isn't individualized tax or legal advice. My goal is to help you understand the real estate strategy and mechanics well enough that you know what questions to ask. If you're seriously considering an exchange, you want your CPA or tax advisor and a qualified intermediary known as a QI involved before the transaction gets too far down the road. Because with a 1031, time matters a lot. Let's use an example. Let's create a hypothetical investor. We'll call this investor John. John purchased a real property years ago for $500,000. For simplicity, we're going to ignore improvements, depreciation, transaction expenses, and all the other things that can affect adjusted basis and taxable gain. This is just an illustration. Today, John's property is worth approximately $1 million, and John wants out. Maybe he's tired of managing it. Maybe the property's return isn't what it used to be. Maybe his investment strategy has changed. Maybe he wants better cash flow. Maybe he wants to move from one type of real estate into another. Whatever the reason, John wants to sell. But John doesn't necessarily want to get out of real estate. He wants to sell property A and move that equity into property B. So John asks, can I sell this property, buy another qualifying investment property, and defer the taxes I otherwise might owe right now on the gains? And the answer is potentially, quite potentially, yes. And that's exactly the type of situation we start having a 1031 conversation. But John can't just take the money. This is where people get themselves into a lot of trouble. John generally doesn't sell the property, have the money wired into his personal bank account, and then decide 3 weeks later, you know what? I think I'll make this a 1031. That's not how the 1031 is designed to work. In a typical delayed exchange, a qualified intermediary, commonly called a QI, is brought into the transaction. The qualified intermediary facilitates the exchange and holds the proceeds rather than John receiving them himself. They don't touch his bank account. And that's why I want investors thinking about 1031s well before the close date, not afterwards. Because once you've received the proceeds yourself, you may have already created a problem that can't simply be undone. So you want the structure established ahead of time. Now the clock starts. Once John closes the sale of his relinquished property, the clock starts ticking. And there are two numbers I want you to remember. Those numbers, 45 and 180. John generally has 45 days from the transfer of the relinquished property to identify the potential replacement property according to applicable identification rules. And generally, he has 180 days to complete the exchange, start to finish. There are tax return timing rules that can potentially shorten that period, which is another reason you want professional guidance. But for our purposes today, remember, 45 days to identify the new property, 180 days to complete the 1031 exchange. And these aren't, well, I was busy that week type of deadlines. These are serious tax deadlines. And that creates what I think is one of the biggest practical dangers of a 1031 exchange, the 45-day trap. Think about the psychology here. John just sold a property. He's sitting on significant equity. He's trying to defer a potentially significant tax bill, and now he has a ticking 45-day clock to identify that new replacement property. Suddenly, John isn't asking, is this an incredible investment? He's asking, can I find something before the deadline? And those are two very different questions. And this is where I want investors to be careful, because avoiding taxes doesn't make a bad investment a good investment. If you overpay by $100,000 for the wrong property because you're terrified of recognizing a tax liability, what exactly did you save? That's why I don't believe the goal should ever simply be, I need to do a 1031 exchange. The goal should be make the best overall financial decision. Sometimes that includes a 1031 and sometimes it doesn't. What does like-kind property actually mean? Here's another area that confuses people. When people hear like-kind exchange, they sometimes think I'm selling an apartment building, so I have to buy another apartment building. Not necessarily. For qualifying real property, like-kind is generally much broader than that. Depending on the circumstances, an investor might exchange one type investment real estate for another qualifying type investment real estate. So the focus isn't necessarily house for house, duplex for duplex, apartment building for apartment building, or even commercial building for commercial building. The properties don't have to look alike. What matters is whether the properties and the transaction satisfy the applicable requirements. And again, that's where your tax professional and QI help make sure what you're planning actually qualifies in advance. What about your primary residence? This is another common misconception. Someone hears about a 1031 exchange and says, great, I've owned my house for 20 years. I'll sell it and 1031 into my next house. Generally, that's not what Section 1031 is for. We're talking about real property held for investment and productive use in a trade or business. We're not simply talking about selling the house you live in and purchasing another primary residence. Primary residences have a completely different set of tax rules, and there can certainly be more complicated situations where a property changes uses or contains both personal and investment use. But again, that's where your CPA needs to get involved. But for purposes of understanding this video, don't think of a 1031 exchange as the normal way homeowners move from one primary residence into another. Now, let's talk about boot. This is one of those words that makes 1031 exchanges sound much more complicated than they need to be. Very generally, if you receive cash or certain other non-like-kind property as part of the exchange, that can be what's commonly referred to as boot. And that can result in some gain being recognized. So let's say John sells his investment property, does the 1031 exchange, but doesn't reinvest all of the exchange proceeds into the new property. He may still have completed an exchange, but that doesn't necessarily mean 100% of his gain was deferred. It's an important distinction. A 1031 isn't necessarily all or nothing. You can potentially have a transaction where some gain is deferred and some is recognized. But now we're getting into the numbers, and that's exactly where I want John's CPA working alongside he and I with the QI. What about debt? This is another area where oversimplified internet advice can become dangerous. You'll sometimes hear you have to buy a more expensive property or you have to replace every dollar of debt. Those statements can be misleading without context. If John's objective is full tax deferral, the value of the replacement property, the amount of exchange proceeds he reinvests, liabilities involved in the transaction, and any additional cash he contributes can all affect the outcome. So instead of memorizing some catchy internet rule, have your QI and tax professional model the actual transaction. Because John's objective may be full deferral, other investors may intentionally accept some taxable boot. Those are different strategies, and that's why the strategy should be designed around the investor, not around the slogan. Now, the biggest 1031 mistakes. So if I were sitting across the table from an investor considering a 1031 exchange, these are some of the biggest mistakes I'd be watching for. Number one, waiting until after the sale to start planning. Start the conversation and planning early. Number two, taking possession or control of the proceeds without understanding the consequences. Don't assume you can receive the money personally into your account and fix the exchange later. Number three, misunderstanding the 45-day identification period. Know exactly when your clock starts and make sure you understand what constitutes a valid identification of the next property. Number four, assuming every property or every transaction qualifies. You can't guess here. Number five, misunderstanding boot and assuming that doing a 1031 automatically means zero current tax. And there's the mistake I worry about the most, buying the wrong property simply to save on the exchange. When should you not do a 1031? Let's say John is staring at day 40. His first replacement property fell apart, his second one has terrible numbers, and the third property is substantially overpriced. John starts thinking, I have to buy something, otherwise I'm going to owe taxes. No, John needs to stop. John needs to evaluate the entire picture because taxes are one variable in an investment decision. They're not the entire investment decision. What's the property's cash flow? What's the cap rate? What's the location? What's the tenant risk? What are all of the expenses? What major capital expenditures are coming soon? What's the future resale potential? What's John's return on equity? What other investment opportunities does John have? And what would John's actual tax liability be if he simply just sold his property? Sometimes investors become terrified of a tax number they've never actually had their CPA calculate. That's backwards. Run both scenarios. Scenario A, complete the 1031 exchange. Great. Scenario B, sell the property, recognize the applicable gains, pay the applicable tax, and redeploy the remaining capital somewhere else. Then compare both scenarios because the purpose of investing isn't to avoid taxes at all costs. The purpose is to build wealth. Why this matters in Seattle and the East Side. This conversation is particularly relevant for longtime property owners here in Seattle and throughout the greater Seattle area, the East Side, Kirkland, Redmond, Bellevue. You may have an investment property that was purchased 10, 20, maybe even 30 years ago, and today there could be substantial equity tied up in that asset. But there's another conversation I'm increasingly having with rental property owners locally. The city of Seattle has deployed an increasingly complex set of landlord-tenant regulations. And some landlords are asking whether they still want their investment capital concentrated inside the city of Seattle. Some are considering selling, some are looking at other cities, some are asking whether they can sell a Seattle rental and reposition that equity into a different investment property somewhere else. And that's where understanding a 1031 exchange can become extremely valuable, because a 1031 isn't necessarily about getting out of real estate. It can be about repositioning within real estate. Maybe you're selling a Seattle rental and looking at another investment in Kirkland, Bellevue, Redmond, Woodinville, or somewhere completely different. Maybe you're moving from a single family rental into multifamily. Maybe you're moving from a management intensive property into something that better fits your current investment goals. Maybe you're consolidating, maybe you're diversifying. The question isn't simply how much can I sell this property for. The better question might be, what do I want this equity to do for me? And those conversations should start before the for sale sign goes in the front yard. The big 1031 picture. So let's bring all this together. A 1031 exchange can potentially allow a qualifying real estate investor to sell investment or business real property, move into other qualifying real property, and defer recognition of gain that otherwise may be taxable at the time of the sale. But it's not automatic. It's not simply tax-free money. It's generally not for your ordinary primary residence move. There are strict timelines. There are identification requirements. There are rules around how the proceeds are handled. There can be taxable boot, and most importantly, a 1031 exchange should never become an excuse to make a bad investment decision. But there's one more part of this conversation that I think long-term investors should at least understand. And that's what can potentially happen to the taxable basis of your property when the owner passes away. 1031 exchanges and estate planning. You've probably heard the phrase, swap till you drop. It's not my favorite phrase, but it describes a legitimate concept that sometimes comes up in long-term real estate and estate planning. An investor may complete one 1031 exchange, then another, and potentially continue deferring that tax gain while owning investment real estate throughout their entire lifetime. And then something very important can potentially happen at death. Under current federal tax law, inherited property generally receives an adjustable tax basis tied to its fair market value as of the date of death. Although exceptions in individual circumstances absolutely matter, when an appreciated property's basis increases to that value, you commonly hear this called a step up in basis. And that can dramatically change the income tax picture for the people who are inheriting the property. Let's use a very simplified example. Imagine an investor originally purchased real estate decades ago for $300,000. Over the years, they exchanged from one property into another, and eventually they're holding real estate worth $2 million. With a tax basis substantially below that value. So capital gains, a lot of gains. If they simply sell during their lifetime, all of that deferred gain potentially becomes due. and very important part of the conversation. But suppose instead they hold qualifying property until they pass away. Depending on the circumstances and the tax law in effect at that time, their heirs may receive an adjusted basis, generally based on the property's fair market value at the time of death. So, let's say the property is worth $2 million at death and the heirs later sell it for approximately $2 million. The income tax result can be dramatically different from what it might have been if the original owner had sold the property immediately before death. And that's why you sometimes hear investors talk about swap till you drop. They're potentially using exchanges throughout their lifetime to defer gain that they potentially will never have to pay, and then incorporate what happens to basis at death into a much larger estate planning strategy. But I want to put a giant asterisk around this entire conversation. Estate planning, federal estate taxes, Washington estate taxes, ownership structure, community property, trusts, depreciation, changes in tax law, and the individual circumstances of the owner and all of their heirs. This all matters. This is absolute CPA and estate planning attorney territory. I have both readily available for you if you are considering a 1031. But I want investors to at least understand the concept, because a 1031 exchange isn't always simply about postponing a tax bill for another 5 years. For some investors, it can become one piece of a decades-long wealth and estate building strategy. To wrap this all up in closing, brings us right back to the point I've been making throughout this entire video. Don't make the tax decisions in isolation. Look at the investment. Look at the tax consequences. Look at the timeline, your cash flow, your goals, your family. Look at your estate plan, and then build the strategy around what you're actually trying to accomplish. If you remember nothing else from this video, remember these 3 things. Plan early, build the right team, and don't let the tax strategy become more important than the investment strategy. Your realtor should understand the real estate side. Your qualified intermediary, your QI, should understand the exchange side. And your CPA or tax advisor should help you understand the tax consequences specific to you. And when appropriate, your estate planning attorney should understand what you're ultimately trying to accomplish with these assets. When those people are communicating before you sell, you can make a thoughtful decision instead of racing against a 45-day ticking clock after the close of your home. I'm Nick Casper, and if you're considering selling an investment property here in the greater Seattle area or the Eastside, and you're trying to figure out what your next move might look like, I'm always happy to sit down, look at the real estate, run through some different scenarios, and help you start building your strategy. Just make sure your tax and legal professionals are part of that conversation also, because successful real estate investing isn't just about what you buy. It's about understanding how you enter, how you hold, how you reposition, and eventually how you exit. And as always, thank you for watching this video. I'll see you on the next one.